good afternoon, everyone, and welcome to today's webinar, where we're going to be addressing a question we've been asked a great deal recently, as I'm sure you can imagine. Is the UK looking at a housing bubble situation? And if so, what can we do about it? I'm delighted to be joined by Stacey Rower today. She's a very important part of the business. She's head of investment management, which basically means that she's heads up the team that sources our deals, that liaises directly with developers. So she, above all, is in a position to tell us exactly what's going on, because she's got daily dialogue with these developers who ultimately are producing the housing stock that we are recommending to our investors. Next slide, please. So, as I mentioned, the agenda today, house market crash, causes and trends. We've seen a couple in the past, and the question is, are we facing the same sort of situation now? An analysis of the current environment and where we see UK house price and rental forecasts. And to give you a sort of an executive summary now, we don't see a bubble forming as in the current market conditions, but what we do see undoubtedly is a slowdown where certain parts of the market are more affected than others. I was looking at other asset classes this morning, and for example, the FTSE 100 is down 3% year to date. However, within that basket of stocks, there are some that have massively outperformed, up 50, 60, 100% in some situations. And that's exactly the same, I think, the housing stock. The UK housing stock is so fragmented. There are so many asset classes within the asset class. I think the key point here is that some will behave differently to others, and it's up to us as investment professionals to identify those that will perform the best. So for those of you that don't know, it's a quick recap on our business model. So we're positioning ourselves as an end-to-end service provider. So what we're doing is going out, researching these markets, providing opportunities to invest, taking care of the lettings and management, the sourcing of finance, and the ultimate either lettings and management, sales, or taking away equity from property and recycling it back into the market. I think the key difference between us and other companies within our sector is, one, we're very much research driven. We focus on city centres, commercial hubs, capital cities, where ultimately you will get the most liquidity and you will get the most rental demand. The other point is that we actually are vested in these projects ourselves. We put money down to secure the stock. We all know that the good stuff always seems to get snapped up locally by people who live locally. And for investors that are living overseas or not in that particular cities, I mean, ultimately, you're in a disadvantaged situation. And the only way that we're able to secure the sort of stock that sells locally, that's in high demand locally, we found over the years, is by putting money down and securing that stock and liaising directly with developers. So that ultimately gives our investors access to the market, which they wouldn't ordinarily get to see if they were, going on the traditional property portals or doing a Google search, for example. So very much an end-to-end service, very much research-driven, lettings and management, mortgage finance, which is absolutely key at the moment, and ultimately on sales for those that want it. Next slide, please. So
that's over to me.
I think it's you, Stace. Why don't you go on this one?
Yeah, it is. Thanks, Johnny. It's obviously good to be back on webinars. So, yeah, I think, as Johnny said, we've been asked the question a lot about what's currently going on in the market. And as sort of part of the investment team for IPG, I do spend a lot of time talking to developers to find out sort of what's going on the ground. And so we decided, obviously, looking at what's currently happening in the market and the economy, to try and look back and see how the current situation is kind of aligning with previous sort of recession. So I'm sure most of us are fully aware of the last few recessions that happened. Obviously, we had the most recent one, which was due to the COVID-19 pandemic. Then we've got the GFC, which is 2008. And then a bit further afield was the 1990 recession as well. So I think a point obviously to note, there's a lot of factors that in today's market that look similar to these recessions. But I think an important thing to note is a recession doesn't always mean a housing crash or a fall in house price growth. As Johnny alluded to, and as we'll obviously give a bit more information later on, is we do think there'll be a softening in the market, but we don't think there'll necessarily be a crash. So yeah, just looking at that graph as well, we've only seen house prices actually crash twice in the past 70 years. So yeah, not necessarily, because if we head into recession, it doesn't really necessarily mean that the house prices are going to crash. So Johnny, I think I'll pass to you. You can give a little bit more context into, I think, the previous recessions and the house price crashes, and I think a little bit obviously also linking it to how IPG dealt with these situations.
Sure. Yeah, I mean, I've got the advantage that I'm one of the few people in the business that has been working throughout all of the last three recessions. I remember them well for different reasons, and I also remember very well what they did to the house market. The early 90s was really a fallout from the high interest rates of the late 80s, and where we saw unemployment spike up to 10.5%. I mean, important to note now that unemployment in the UK is less than half, and yes, it will probably increase, but certainly not to the double-digit levels that we saw in 1993. 2008 was a very different scenario. The main issue there, as far as house prices were concerned, was the lack of liquidity, I should say, in the banking sector. Those I'm sure watching will remember the banking sector seemed to go into free fall, and no one quite knew where it was going to end up. But the net result is purchasers couldn't get mortgages in many situations. I remember the first deal that we did in London, which was in June 2009, our first underwrite deal, just around the corner from the IP offices, actually, on Old Street. We were in a situation where we took on, I think, 40 units from a Spanish investor that was unable to complete. So we underwrote those 40 units. And appetite at that time was pretty strong. It was helped by the fact that sterling was very weak, almost as weak as today, but not quite. But our main issue was that out of the 40 units that we took, probably only 10 or 12 could actually get bank finance. So the majority were cash purchases, and that was the issue. That back then, no one really was able to get finance for an extended period of time. But obviously that eased up quite quickly, and we were then in a situation where interest rates were very low, and once the liquidity came back, you saw asset prices go up pretty sharply, certainly gaining most of the losses that they had made very quickly in the following 2 years following the sort of 2008-9 crisis. So I think that the situation today is very different. You've almost got a polar opposite situation where there is so much lending in the system. And yes, interest rates are going up, and we'll talk about that more in a minute. But the point is that there is lending available for those that need it.
Next slide. I think Johnny sorry, I was just going to jump in there. I was like, just to add to that, obviously, I think it's far more regulated now. And also there's a lot less leverage in the market. So, it's not like it was sort of in that 2008.
Yeah, I mean, talking of that, there was a statistic that I read, I think it was in the FT, it was last weekend, that 70% of the UK housing stock, or 69 to be precise, is owned by 55 years and older. And within that sector, less than 25% have finance in place. So most of them own their properties outright. So as and when we face further interest rate rises, which we will, no question, that would suggest that the impact to much of the housing market, not all, will be fairly minimal. Sorry.
I think I read a similar article. It was, I think, ages between 55 and 64, there was like 450 billion worth of housing stock, but only 100 billion of that was actually mortgaged. So, like landlords in that age group are relatively low leveraged in debt. So, the risk there with these interest rate rises isn't as high as they were previously, and obviously at previous recessions.
Sure. So I think one of the points here is that the housing market supply is still woefully short of the targets where it needs to be. And I think the key point is it's the affordable housing supply. I mean, it's not as if there is such a shortage of stock that people who want to buy houses cannot, because they obviously can. But we're talking about affordable stock where if you work back to how much people earn, can they afford their mortgage payments even in the face of an uplift in interest rates? And that's the housing supply that's really squeezed at the moment. And there are a number of reasons for that. I think the antiquated laws within the UK, that it seems to take such a long period of time to get planning permission through. The other issue is that there's still this sort of COVID hangover from local council and the ability to make decisions quickly. But I think most important these days is the issue of inflation. Now, Stacey, you talk to developers every day, so you're understanding why firsthand that they are loath in some situations to start construction and start pricing for something that might not be built for a year or 18 months, because quite frankly, they won't know how to price it, will they?
No, exactly. And I mean, it's sort of been ongoing now for about, I think, 12 to 18 months, where there's just, they're no longer getting fixed price contracts, and yeah, their cost of material is just constantly increasing, and they actually can't fix the price, which means they're either putting a hold on developing until they're sort of like, a flattening out or a bit of stabilizing in those prices, or they're pricing in the risk, which is, sometimes, 10 to 20%, just to make sure they're covered by any future increases in the raw materials. And like you say, Johnny, working on off-plan developments, that's a 12 to 24 month build period. So anything could happen in the last 2 years, as we've seen. So it has been difficult, I think, for developers. I mean, it's been difficult for us to source because, as I said, a lot of people are just, maybe sitting back, not making those decisions, or the prices are just, they don't know if it's just really risky for a developer that some of them would rather, just sell later on, so they can sell at the price that makes sure that they get that profit that they need. So I think that's definitely a major one. I think another one that developers have brought obviously to our attention is the shortage of labor, and I think it's across a lot of markets, but that's one of the biggest things they're struggling with at the moment. And obviously the shortage of labor becomes the cost of labor, which is another increased cost along with those materials. So yeah, I think the massive underlying issue here really is the limited availability of stock and limited availability of supply. And as you're saying, Johnny, like people need houses and people need homes, and I do think it's, there's still a strong demand, and a lot of it is sort of, pent up demand of COVID. People didn't make decisions then, they sort of sat on their hands for a bit, and there's a lot of people who now want to, actually snap up property and get into the property market because they've been waiting, and snap up properties at reasonable prices, and they're just not available in the market at the moment. So there is that pent up demand that I think will continue, as supply continues to come to the market, albeit it will be obviously slow from the supply side.
Absolutely, but I think, rather than just sort of say this applies throughout the whole market. I mean, as I said at the beginning, the UK market is very fragmented, and property on the coast of Cornwall or Devon is going to behave differently to prime central London, is going to behave differently to Manchester, Leeds, York, city centre or city fringe. And it's very important to identify, those individual groups, because clearly, non-discretionary property like holiday property on the coast, in times of economic hardship like we're facing now, are going to be in less demand than they were 2 years ago. So you would suggest that the prices may fall on that more significantly than maybe city centre or city fringe, where we've run the numbers and understood them to be affordable as far as the average wage is concerned. So it does come back down to which particular niche you're looking at within the property market as to whether or not the prospects are looking good or not over the next 3 to 5 years, and also that issue of affordability. And I can't stress that too much. And that's really where our challenge lies as a business, is finding that affordable stock. I mean, it's not impossible, and we are still doing that. And I think that the point of us putting down capital and de-risking projects for developers is key in this market, and giving our investors access to, as I say, a very different type of stock. Next slide, please.
Yeah, I couldn't agree with you more, Johnny. I think, like, you know, the markets that we're looking to invest now are definitely markets that have very strong fundamentals, which we obviously believe are going to stay. And one of those really is affordability, which we look at very closely.
Sure. This is probably a graph that everyone has seen several times before, interest rates showing where it was pre-global financial crisis in 2008, 2009, and where it is now. Clearly, we've had 10 plus years of very, very low interest rates, and clearly things are changing in the face of rising inflation and rising costs. I mean, we've had 6 within the UK, where I'm based. We've had 6 rises since December, and whilst the base rate is now at 1.75, we're potentially looking at an uplift to 3% at the beginning of next year. So fundamentally, things are changing, no question. But still, I would argue that given the lack of leverage in the system in most parts of the housing stock system, and also the fact that historically they're still at relatively low levels, you would argue that this isn't causing or going to cause the shock that some people are suggesting to precipitate a house crash. I think next year and in the year after, well, I think next year, I mean, reading about it, interest rates are going to peak and then they're going to flatline for a period of time. And then we could well be looking at a time where they start to decrease. So important to, I guess, go in with your eyes open in any of these investments that you're thinking about, and understanding interest rates and stress testing your own your own investments. Can I still afford to buy this property if interest rates are at 4 or 5% compared to where they are now? Does the rent still cover it? And if it doesn't, can I afford to make up the shortfall? You know, these are all things that need to be thought about before making any sort of commitment. And certainly as a business, we can assist with, but ultimately, you know, we have to face these facts straight on. Anything else to say on that part, Stace?
Can we go back? Not too much. I think, yeah, you've pretty much covered it, Johnny. I think, again, like, households are a lot less leveraged nowadays. I mean, especially I think in the UK. I mean, you do get markets like I think it's Canada and Australia who actually are far more leveraged, and there's a lot more you know, your higher mortgage rates in those markets, and those are obviously far more subject to bigger increases with these interest rates increases, or sort of, you know, yeah, far more detriment type of thing. So I do think with you know, more regulation in the mortgage markets and the lower leveraging, it's obviously going to have an impact, but not as detrimental as maybe sometimes, you know, sort of blasted on the news headlines and that.
Yeah, I mean, this is an important one, and again, something that we can't deny. And for those foreign investors who are watching today, you're looking at a significant discount to certainly the beginning of the year and a year ago. You know, if you're spending $50,000 US, just reading the numbers there, that would have bought you £35,000 in May 2021. It would buy you £43,000 in September 2022. There's even talk of the US dollar reaching parity. Who knows where it's going to end up? But certainly, if you are a foreign investor, there's real value opportunity, and the purchasing power of your dollars wherever you're based, or your renminbi if you're based in China, is significantly up from where it was. Certainly, if I think back to the past global financial crisis when I was living in Hong Kong in 2008, 2009, I mean, there was a lot of chatter when it went below 10, because, you know, 6-8 months before that, Hong Kong dollar sterling was 14, 15. And then it went down very, very sharply. GBP yen as well went down from sort of 220 to 120 almost overnight, caught a lot of people out. And actually that pretty much spelt the end of multi-currency mortgages, where you could buy a property, a UK property, and take out a Hong Kong dollar mortgage or a yen mortgage. Because the interest rates were so much lower then, it did end up that the debt was, massively increased following this sort of significant devaluation of sterling. So the point here is that sterling is down, definitely. It's probably going to stay down for a while, and I think certainly from sort of Hong Kong dollar, US dollar, is it normally trending, or should it be trending at 115 or just over 9 in relative terms? Probably not. So, you could argue that this is an opportunity. And certainly this is the sort of opportunity that keeps those markets like prime central London up, because, there's a large proportion of foreign investors investing in these types of markets. So whilst, affordability may be challenging for local UK investors, if you're looking at those sorts of currency discounts, you might sort of think about investing in London versus your own country, where you can get this sort of discount. Yes, next slide. So I guess really the question is, well, what's going to happen over the next 5 years? I mean, my take on it is, I think that things are going to be moving sort of sideways or very low growth for the next year, 18 months. But if you're prepared to take a sort of 3-5 year view on these things, which you should, I mean, property is an illiquid asset. It shouldn't be thought of sort of buying 1 year and flipping the next. In most situations, in most jurisdictions, there are taxes, prohibitive taxes, to stop people doing that. I mean, in Hong Kong, there was the sort of confirmers, as they were called, and that was, I think that was made illegal a long time ago, 8-9 years ago now. But property very much should be viewed as a medium long-term hold. And look, whilst I absolutely acknowledge that it's not a particularly nice feeling to buy a property and know that it hasn't really gone up in value in the over 12 months, or in fact it might have come off 3-5% in some situations. If you've still got a tenant in there paying off your debt, the key thing is to keep your eye on the medium long-term hold that you should have had in mind when you first bought the property. And just on the subject of rental forecasts, I mean, we manage around somewhere between 3,000 and 3,500 properties up and down the UK. So, we're very close to the rental market here. We can see day to day exactly what's happening, what the vacancy rates are like, and what the rental increases or decreases might be, as the case may be. And very much it's been a story of growth over the last 6 months, when people have been renewing their tenants. With inflation now running at around 8-10% in the UK, whichever numbers you're looking at, rent rises have followed suit and are very much in that sort of ballpark category. They can't keep going up by 8-10% a year. We were just talking about it earlier, and the question is, well, where are they going to top out? But the fact is that whilst you're in a position where your rent is covering your debt or close to it, then it's really a case of remembering why you bought that property, and that adopting that sort of medium long-term hold. I think that's the key message, is not to panic. And there are times, I think, when being in a liquid asset is an advantage. You're not going to suddenly sell something when you really shouldn't, which is probably around about now.
Yeah, no, I mean, I think you've sort of hit the nail on the head there, Johnny. I don't actually have too much to add, sure. But like you said, I mean,
well, we've got a lot of questions coming through. We've got a lot of questions. So should we get to the last slide here and then start taking some questions?
Yeah, I think we can do that.
Okay. Do you want to take that, or shall I, Stace?
Yeah, I can take a bit of it. I think it's just a bit of a wrap up of obviously what we discussed, and what the current markets are doing. So I think important things obviously to note is, with the rise in inflation, cost of living, the interest rates, at the end of the day, there are historically low unemployment rates. So as it says there, it's 4.1%. The job market is very tight at the moment and buoyant, and it's people, there aren't mass job losses at the moment, so people do still have that disposable income. And in a lot of markets that we do look at, we do look at the the disposable income of people who live there, and it is definitely going up, and that unemployment is still staying very low. So I think that's an important thing to actually concentrate on, that it's different from other recessions and other different scenarios where those have been incredibly high in the past. I think the leverage one, I think, Johnny.
So I was going to say, I'll take the next one. I mean, look, in terms of the leverage situation, again, it's night and day from where it was back in 2008, 2009, both in the run up where, banks were offering 100, 105% mortgages without really any sort of checks at all, to now where, the stress testing has really become quite an issue for some investors that would like to buy, but once they look at these, the stress testing, the uplift in interest rates that are coming through, banks just won't lend. I mean, there is talk of banks easing these stress tests. I'm not sure if that's a good or bad idea, but in many situations, we're looking really where our investors are looking at sort of 60, 70, 75% mortgages for the investor loans, rather than 50, 60%, where the cash flow is marginal and any increases in interest rates will cause issues. And in the majority of situations, we're just not in that territory now. Again, we're not saying everything's going to be fine, everything's going to be rosy, because it's not. There are economic headwinds. It's tricky here in the UK for a number of reasons at the moment, but we are saying within that, these are not the obvious reasons why there's going to be a crash. And I think leading on to that, the low housing supply. I mean, I was actually talking to someone in China this morning, where we have a number of investors, and ghost cities out there are still a thing, and that's something where investors have built a huge amount of supply of properties, and the old adage, build and they will come, and actually they haven't. So you're in a polar opposite situation in some regions, in some countries, where there is just too much supply, and we're just so far away from that here in the UK. The challenges that we're finding to get and source stock is something that I've not seen before in the last sort of 15 years that I've spent in this business, and I can't see it changing anytime soon. So without doubt, that's going to cushion some of the blow. Sorry, Stacey.
No, it's okay. I was going to just jump in there quickly. Obviously, I mean, I think the major factor here really, and I think what's going to very much keep those prices, growth, albeit it's maybe small, is really the major factor that there's just not enough supply in the market. I mean, I see there, and I think in our chart earlier, it said that the target was 300,000. They recently actually increased it to 465,000 because they were only delivering half of what was actually delivered over the past couple of years. So already that's another 165,000 new homes and 50% increase that they need to do in the next, I think, 2023 and 2024. So if we're not hitting them now, it's going to be a constant struggle with supply.
Sure. And I guess, as I say, the last point, the market is so fragmented here. I mean, it is made up of sort of markets within markets, and we're not suggesting that everything's going to be fine. I noticed one of the comments, we were told that we're painting a very rosy picture. Well, that's not the intention at all. We're trying to be realistic here. The market is going to slow, no question. Some parts of the market will be hit more than others. But the point here is that the sort of medium long-term view on these markets is still very, very positive for the reasons that we've just talked about. And I think I've probably just talked our summary slide. Is that one next, or we finish that one?
No, I think this is the last. I think this is the last one, Johnny.
Okay. So questions.
Move to some questions. Yeah. So let's see what we have here. Okay, Johnny, this one can be for you. How will investors choose differently in this recession?
I don't think necessarily they'll choose differently, but they have to, I think, make the decisions a bit more accurate than they were before. The key thing is affordability. No question, affordability is being squeezed in the UK. We're seeing double-digit inflation, the most we've seen in 40, 45 years here in the UK for sure. So that's causing people challenges. The emphasis again is on affordable property. It's almost reverse engineering back. So you're looking at a property, you're looking at what you need to make it a sensible yield for you. And then you work back and think, well, okay, if that's my yield of X, what are people earning in this area and can they afford it? And you need to be very careful on that. It's no good just buying a property and hoping for the best. You need to, I guess, adopt a little bit more science and analytics behind it all, and working backwards from, what your target yield is going to be and what the affordability is in that area. I think the other thing is, and this is something that's being more talked about now, is the energy efficiency rules are changing here in the UK. Obviously, energy is extremely expensive now. And that's become a lot more topical, and older properties that were traditionally sort of favoured above new build because the perception was they were a little bit cheaper, which maybe they were. You could argue it's a bit of a false economy these days, because certainly newer properties will be built in accordance with what's required today in terms of energy efficiency. And if you built an older property, that could well require a fair bit of work and maintenance to bring that up to standard. And if it's not up to standard, it won't be legal to let it. So my advice would be, think carefully about the energy efficiency, think carefully about the affordability, and obviously the location issue as well. City centre, city fringe, you don't tend to go wrong with that sort of thing.
Yeah, no, I agree with you as well. Thanks, Johnny. Let's see what other ones we have. Oh, yeah. Okay, what does a cooling housing market and inflation mean for developers? So I think I'll answer that one, Johnny. I mean, I think we kind of alluded to it in our current market slides. I think obviously developers are facing lots of obviously challenges at the moment. And again, this is just, I feel like I've said this a lot, but it's just obviously increasing the undersupply of homes within the market at the moment. So I think just to sort of summarize what we touched on earlier with the challenges developers are facing, obviously labor shortages and labor costs are definitely going up, and there's a massive shortage at the moment. The cost of materials, they can get no fixed contracts. Obviously there's been supply chain issues, just fluctuations in the cost of those raw materials have just made it very risky for developers to cost a building and develop it. So a lot of them have just already, sat back for a while and seen when it sort of calmed down a bit. And then I think the planning permissions, Johnny, I think you also touched on it earlier, but it's just becoming a longer process to get planning permissions. There's always constant opinions to change certain things or to adjust it. And also the build-up from COVID and obviously all those government workers working from home, the turnover has, I think, increased by a couple of months at a time, which just means, that backlog is getting larger and larger, and it's taking longer and longer for these developers to get planning permissions. And sometimes developers actually think it's not, maybe worth the time or effort with all these factors. So they just, they look to sit or they look to sell off the land. And I think another thing I think you were also mentioning about refurbs, which a lot of people might not know, is if you refurbed a building, obviously from an office to a resi, you used to get a much sort of shorter planning permission timeline. I'd say 6 to 8 weeks, 12 weeks maximum. And now that those buildings are actually subject to a full application, same as a new build. And a lot of that is obviously to do with all these new regulations coming in on buildings on completion, Johnny. So yeah, there's no quick fix anymore, I should say. It's taking a long time, it's costing a lot of money. So it is definitely a challenge for investors, and we have seen just a slowing in development, and again, just pushing up that undersupply, or pushing that undersupply further and further. So yeah, that's sure. I don't know if there's anything you want to add to that, Johnny.
Yeah, there's a lot of questions coming in now, so I'm going to cover a couple of quick ones here. We've asked, what interest rate level do you put in your models for foreign investors? We're putting in anything between 5 and 6% at the moment, and again, we're looking to stress test that. Interest rates now for foreign investors are around about 4, I would say 4.5, but they're going to go up. So we need to understand what that means in real terms for cash flow. How about forecasts on rental yields? We're being asked, and especially in London. They've gone up significantly, certainly in London and most of the cities that we manage across the UK. I mean, average, I would say, is somewhere between 7 and 10% across the last 12 months. Is that achievable going forward, that we're going to get year on year? It isn't, I don't think. Again, the affordability issue comes in, but I do think that, you know, even when they start getting back to more normal levels, we'll still be looking at a sort of 3-4% uplift per annum. And again, that comes back down to the shortage of rental stock, but it's the shortage of rental stock in the affordable areas that we look at, not just this blanket approach. It's targeted, it's very targeted in the areas that we like, which are typically city centre, city fringe. Where is that value and affordability? What else are we being asked? How about forecasts on rental yields? I've just covered that. What else is there?
I think there was one saying, how do we think regional, so we talked a lot about London, Johnny, but how do we think regional cities, some regional cities will perform? So obviously I mean, you want to go first and I'll jump in after?
You go.
Okay. No, I was going to say, I mean, we obviously do a lot of business in this regional cities because we do think there's obviously a lot of potential for both capital and rental growth in these cities. Again, the cities we look at regionally, or a lot of research goes into them, make sure they have the right market fundamentals. As Johnny said, I think numerous times, is the affordability, and also a major sort of indicator that we do look at is that undersupply. So looking at, you know, what the population is doing, how the demand is growing, and then how you know, the local councils are actually delivering on their housing stock. And when you get into those numbers, it's sometimes actually quite shocking to see how undersupplied these cities are. And I think whilst you can go to them and you see, you know, you see skyscrapers and a lot of construction happening, I think Manchester being the most obvious example, there's so much construction going on there. But if you actually, you know, go down and look at the actual figures, Manchester still has an undersupply of over 80,000 units. So that's a massive supply. To try catch up that is going to take ages. And now with, you know, all these challenges from a supply side, it's just going to get worse, that deficit. Same as other regional cities like Birmingham. I mean, Birmingham only been, I think, delivering their target of housing 50% of it. I guess similar to the UK overall. So again, that deficit is just going to build and build. And then, yeah, other sort of maybe smaller cities like York. I mean, I think, Johnny, we were looking at a stat the other day where they had only delivered, I think, under 300 homes in a year.
Yes, 299 homes last year. And
they're supposed to be at 2,500. So, yeah, it's, you know, there's going to be demand there, and there's going to be price growth over the next, you know, definitely 5 to 10 years because of that ever increasing deficit in supply.
Yeah, agreed. Being asked another question here. The current price point, it feels like new build prices require 35 to 40% deposit to break even on cash flow. Is this an accurate assessment of current price points? I think it depends on what sort of mortgage you take. If you take a principal and interest, then your monthly payments will be higher. If you take an interest only, then they will be lower. So that means that you can put down a smaller deposit to get your cash flow breaking even. But again, I would always err on the side of caution. I mean, interest rates are rising, so breaking even today may not mean that you're going to break even in a year, 18 months. So you need to be sensible about the real picture as to what's happening. I mean, yes, rents will go up, will continue to go up, probably not at the rate that they have been in the last sort of 12 months. Interest rates will go up. But again, I think they will probably peak around December, January, and then sort of stay at that level while we get inflation under control. And then I think the Bank of England will take a view from there. Any other We got any other questions, Stace? Conscious of time. Currencies. We always get asked about currency. Impossible to predict where sterling, US, and Hong Kong is going to go, other than or renminbi, other than, you know, this would appear to be significant value in foreign currency terms. Is it the bottom of the market as far as with GBP? I don't know. You're always lucky to catch the bottom, aren't you? But I would say we're probably there or thereabouts. And it's, yeah, not a bad time maybe if you're an overseas investor to put maybe a larger deposit down.
I think we're one with Johnny.
Yeah, go on.
And then yeah. So given the increase in inflation rate, the mortgage rate will keep on going up. Does it mean that more and more people decide not to purchase a property and go to the rental market? That is going up for the rental market, but going down for the seller's market.
That's, well, we've seen that probably over the last sort of 6 months when affordability has been squeezed. There was that sort of initial rush to get mortgages approved because it was clear where interest rates were going to head, and there was a rush to get those mortgages approved. But what we're seeing in the market here in the UK is that many people are looking to maybe rent for a period of time while interest rates sort of sort themselves out and then come back into the market that way. So it may well cause a squeeze on rental supply in the medium term, which is already squeezed. I mean, the average void that we're finding in most of our stock is less than 10 days. In many times it's shorter, just to facilitate that turnaround to get new tenants in. So it's already a tight market. I mean, I think it's not as tight as it was a few months ago. I was reading all sorts of things where people were offering 12 months up front and larger deposits and outbidding each other. I think that's calmed down, but without doubt the rental supply remains tight.
Yeah, no, I fully agree, and obviously not only because of the increased obviously inflation and interest rates, but again, the lack of stock sort of in the market. You know, it is pushing people. They can't buy because there's just not availability there, so they are getting pushed into the rental market. So there are a lot of these push factors at the moment into the rental market. And as you say, and the feedback we're getting from Complete, our lettings and management partner, there's people sort of, just biting sort of at the bit to get into those different apartments, and the turnover and the void periods the void periods are very low at the moment. So I definitely think it's driving up that rental market at the moment.
Sure. Okay. I think that's a good point to wrap up. Thank you all that joined us today. I mean, to summarize, it is going to be a challenging few months, 12, 18 months for the UK property market, no question. I don't think we're going to see the sorts of rises that we saw post-COVID, stamp duty holidays, low interest rates. I mean, the world is a different place now. But our point here is that the UK property market is fragmented, so some parts will perform better than others, no question. And the other point is to maintain that medium long-term view. And during that time, the key point is to concentrate on your cash flow and making sure that your costs are covered as much as possible, and making sure that the initial calculations of stress testing your interest rates are correct, and also where rental market is heading as well. If anyone's got any other questions, please feel free to send us an email through. I'm conscious of the fact that we haven't answered all the questions today, and we'll do our best to do that. But in the meantime, thank you again. Thank you, Stacey, for joining, and look forward to connecting with some of you soon. Thank you.
Thanks very much, Johnny. Thanks for having me.